Hi, this is Chris Smith from theoptionclub.com. Once again on our discussion boards, we've started talking about a trading service that calls itself Radioactive Trading. And the position or the strategy that they trade is something that they call a radioactive profit machine. Well, radioactive profit machine, as we know from the free materials they hand out, is simply an in-the-money married put. And the position is created by simply buying 100 shares of stock and buying one in-the-money put to protect the position. By buying an in-the-money put, you effectively guarantee yourself a sales price for your stock that is above current market levels. Now, that's not a freebie. You're going to have to pay for that. So if you buy, let's say, a $50 stock and buy a $55 strike put option, you have the right to sell that $50 stock at $55 no matter what the stock does. You're going to have to pay at least the difference between the current market price and the strike price, namely the $5. You're also going to have to pay some amount for time value. That is the amount of time that the put option will be in effect. The risk of loss is limited to your time value in the put option. So if you have very little time value in there, you have very little at risk. But you also have probably not a whole lot of time in which to hold on to that position in its protected state. Now, holding the married put puts you in a position now to trade or make adjustments to the position, and the radioactive trading folks give away their first income method for free, and it's simply selling a call option against the married put. Now, because you own the put and because you own the stock, selling a call option does not expose you to any naked option position or any risk associated with a naked option position. But what it does is it brings in time premium from the sale of the call option. In the radioactive trading materials, what the objective is to sell a call option at or above the current strike price of your put option with sufficient time value in it to either substantially reduce or perhaps even eliminate the time value risk of the married put position. So when you open the married put position, the only thing you have at risk is the time value, and your goal is then to sell a call option that neutralizes that time value risk. Once the time value is eliminated, the position is effectively a risk-free trade, or in RPM terms, they call it being bulletproof. In order to fully understand what's going on, you need to understand something about synthetic relationships. Stock and or options can be combined with each other in order to create other positions or positions that have the equivalent risk and reward benefits of other positions. We all know that when you buy stock, you have an unlimited upside profit potential, which means that if you buy the stock, say for $50, that stock could go to 100, it could go to 200, it could go to 300, and you are going to enjoy profits all along the way. But you also have an unlimited downside loss potential, at least all the way down to zero. So if the stock goes to zero, you can lose all of your capital. We can create synthetic stock without ever owning the actual stock. And the way we do that is simply by buying a call option, which gives us the unlimited upside profit potential, and then selling a put option, which provides us with unlimited downside loss potential. Now, why would anyone want to do this? And I'm sure there are probably people out there who take on synthetic stock positions, but if you buy a call option and sell a put option, your actual capital investment is going to be relatively low as compared to the cost of buying the stock. Now, we can also create a synthetic call option. Now remember that a call option has an unlimited upside profit potential with a limited downside risk. To create that same risk curve without using a call option, what we can do is buy the stock that gives us the unlimited upside profit potential, and then provide that limited downside risk by buying a put option. That is a married put. So when we talk about these radioactive profit machines, what we're really talking about is the synthetic equivalent of simply buying a call option. The difference is that a married put is more complex because it involves buying both a stock and a put. It's a little bit more capital intensive because you're going to be putting money into the purchase of an option as well as into the purchase of a stock. So you're not going to gain any leverage. And you're also going to have some additional costs because you're going to have the commissions on the stock side of the trade. So here's a risk curve for a married put position. As you can see, we have a limited downside risk here. That's the most it can go down, and unlimited upside profit potential. Here's a risk curve for a call option. It looks very similar to what we just looked at. So here are the two risk curves. They are essentially identical to each other. Unlimited upside profit potential, limited downside risk. So let's compare one of these married puts or RPM positions versus simply buying a call option. And what we'll do is we'll set up a hypothetical side-by-side comparison. We're going to use calls and married puts. These are instruments that are best suited for bullish markets because of the upside profit potential. We're going to analyze CROX, CROX, which is a stock that has been subject of a lot of price appreciation. It's pretty volatile, which may be a candidate for a trade such as one of these married put positions. We're going to adopt equivalent positions using a married put as well as a call, and then we're going to show how they can be managed using income method number 1, which is selling a call option in an equivalent fashion. We're also going to account for all capital expended. Here's a price chart of CROX. This is a company that manufactures proprietary resin-based shoes. They're very popular, and that popularity of their shoes, along with their proprietary resin, are the fuel for their ascendancy in the stock market. This is a stock chart as of January 4, 2007. So what we're going to do is we're going to open our positions. We'll start with our married put position. We're going to buy 100 shares of the stock at $43.95. That is a total capital investment so far of $4,395. We will then buy one January 08 $55 put option. This gives us approximately 1 year on the put option that'll protect our stock. So what we're doing is we're buying the $55 put option, which guarantees us the right to sell the stock at $55. The cost of that is $15.40. Remember that that is per share, so the total cost of the put option is $1,540. The entire position cost is $5,935. The calculation is set forth below. which is basically the $43.95 share price plus the $15.40 put price times 100 shares. Our position risk is only $435 though, and the reason for that is that we don't, even though we're spending over $5,900, that position is hedged, so we only have a small portion of that capital at risk, and the portion that's at risk is the time value. Now we're going to set up our call option position. We'll simply buy one January 08 $55 call option. That is equivalent to the in-the-money put position. So right here, what you want to make note of is that an in-the-money married put is equivalent to an out-of-the-money call option. We're simply buying the same expiration date, same strike. The total cost for us on this is $4.90. Our entire position cost is simply the $490 times 100 shares is $490. Our position risk is $490, which tells us that we can lose the entire investment in our call option. But you'll note that the cost of our call option and the cost of our and the at-risk portion of our married put position are similar. Now, here's the price chart for CROX as of February 2nd, 2007. We've seen an increase in price, and we are now going to adjust our positions, both the married put and the call. We're going to use income strategy number 1, which is freely available from Radioactive Trading, and it is simply to sell a covered call. We're going to adjust our married put position. We're going to sell the June 07 $55 call for $7. This creates a synthetic call calendar. All right, we've already talked about synthetics. We've covered the idea that married puts are effectively a synthetic call. So when we talk about owning a January 08 $55 put option plus 100 shares of stock, that's the equivalent of a January 08 $55 call option. By selling a closer in, a June 07 option, which expires 6 months prior to the January 08 contract, we're in a call calendar. And once you understand synthetics and you can start recognizing these positions, you'll become a lot less confused when people throw positions at you. The cost basis of the stock plus the January 08 $55 put option is $59.35, but our risk is limited to the $4.35. We now have a risk-free trade now that we've sold a call option for $7. We also have a minimum profit of $232 or 3.9%. Now, keep in mind that because we've sold a call option, our upside profit potential is now limited. And our greatest profit is going to be experienced if CROX were to close as of the June expiration directly at $55. The likelihood of that happening is very low, but that's where our greatest profit would be reaped. So what do we do with a call option? Well, we do exactly what we did with the put option. We sell the same call option for $7. This creates a call calendar spread. Our cost basis on the original call was $4.90. We've now sold a $7 call option, so we have a built-in minimum profit of $210, or approximately a 42.9% return. Now, you'll notice that the profits on the trades are not identical, right? One's $232, one's $210. You'll remember that the time value for the call option was a little bit greater than the time value for the put option. This creates the question, does the call option cost more? Time value is the only component of our trade with either the call option or the married put that is at risk at any time. The time value of the married put was $435, while the call option was $490. So from a time value perspective, the call option would appear to be more expensive. But if the positions are truly equivalent, why would there be a difference in the time value? The answer has to do with interest earned on capital. The married put requires a lot more capital, which means that that money cannot be invested elsewhere. So you're going to forego any profits that you might otherwise earn on that capital. The call investor, on the other hand, requires only $490. So when you back that out, the married put investor has put in over $5,400 more into their trade, which means that $5,400 isn't earning interest or profits in some other investment. So what happens if the call investor takes the additional capital that is now free because they haven't sunk it into a married put position, and they simply receive a risk-free rate of return? Well, let's talk about risk-free rate of return, and we're going to basically tell you exactly what the risk-free rate of return was as of January, January 07, when we opened this CROX position. There was a $55 difference in time value between the call option and the put option. There was a $1,050 difference in the cost of the call versus the cost of the put option. The put option, you'll remember, was more expensive because we were buying a lot of intrinsic value. So if we were to divide the $55 premium that we paid for the time value in the call by the additional capital required for the put option, we come up with 5.2%. Now, that's not a precise calculation for 1 year because we bought this a few days into January, and the January 08 option doesn't expire until the third Friday of January 08. But it's pretty close. So we can probably round it off to about a 5% annualized return, which is equivalent to a risk-free interest rate that we could probably obtain from an FDIC insured bank. So let's recap. The married put is a synthetic call option. Both the married put and the call option have equivalent risk profiles. The call option allows you to adopt an equivalent position in the market, but with an overall lower cost and lower capital requirement. Because the positions are equivalent, you can effect similar adjustments to both positions and manage them in a similar fashion. Now, when there was a lot of discussion about the radioactive profit machines and trading married puts, I went ahead and bought the blueprint that they sell. Now, the adjustments and the positions that are used are not proprietary, but I'll honor the author's intellectual property, and I won't reveal the details of it. But what I will tell you is that there's no magic in there, and that the adjustments discussed in there don't magically create income. They don't do anything that is unique or special or somehow proprietary to radioactive trading. Everything that is done with these married put positions can be done in an equivalent fashion with a call option. So let's now expand beyond our discussion and leverage the information that we've gained. Since a married put is equivalent to a call option, we can sell a near-month call against the more distant month married put and create our call calendar spread. The married put's no riskier and it's no safer than a call option. Not, one's not better than the other. They're equivalent. Right? If something's equivalent, it means that it's the same. And if it's the same, one can't be better than the other. They're effectively the identical position when it comes to a risk-reward perspective. So the question you need to ask yourself is, are you a call trader? Because if you're going to go into the market and start trading married puts, you're trading call options, the synthetic equivalent of a call option. It has all the risk, it has all the benefit, it is identical from a risk reward perspective. If you are not comfortable buying a call option, you really have to have a heart-to-heart to yourself and ask, why am I now willing to trade a married put position? Next question. Do you trade call calendar spreads? Income method number 1 is not a covered call. It's a call calendar spread. Okay? So don't get confused about this. You're not trading a covered call position. You are trading a call calendar spread. It is different than it's different than a covered call. And you have risks that you don't have with a covered call and vice versa. They're two different positions. Your management decisions for your call calendar spread will mirror the same decisions that you're making when selling your near-month calls against a married put position. Okay, so if you're not comfortable managing a call calendar spread, you're going to have difficulty managing a married put against which you're selling front-month calls. So let's wrap this thing up. Here's a couple thoughts. The first is, let's beware of clever names that people selling products want to apply to option trading strategies. I've heard of covered calls referred to as renting your stocks. I've heard one fellow referred to himself as a stock landlord. These are all just little clever names that people are using to market their service or their product. I don't really have a problem with it. We live in a capitalist society. I'm all for people making money. I like to make money. But here at the Option Club, what we want to do is we want to kind of pull the curtain back, dispel all the smoke and mirrors and all of the marketing hype, and get down to what is really going on here. Keep in mind that there are no proprietary strategies. All possible option strategies are already known. Focus your efforts not on chasing the sexy sounding trading strategies, but rather focus on the fundamentals. You need to learn about options. You need to understand options, the nature of options, which means you need to understand option pricing. Option pricing has come out of the Black-Scholes model. There are a lot of models that have been developed since Black-Scholes, but it's all based upon that work. So if you understand how Black-Scholes works, you're going to largely understand how the other pricing models work. You need to understand the Greeks, which are values derived from the Black-Scholes formula. You should understand synthetics. You should understand a concept called embedded positions. If you understand these things, you're not going to have the wool pulled over your eyes. You're also going to understand why your option positions are responding the way they do in the market. Once you have an understanding of option fundamentals, then you can start applying that knowledge to the market, and you need to focus on managing risk. And if you can do these things, you're not going to have need for trading services.